Hello and welcome to the Rask Network. What you're about to hear and see is limited to general financial information only. Please be sure to speak to your financial planner or refer to our financial services guide available at rask.com.au/FSG before acting on the information.
Welcome to this episode of the Australian Property Podcast.
Nice to see you, Owen. Apologies from Pete Wargent, who's living it up over in the States. I think it was at Disneyland or Universal Studios today. So was a bit unfair to invite him to do a podcast from there, but hope you're having a good time, Pete. And happy Sunday to everyone to our 2 Cents episode with Owen and I. And looking forward to this, mate.
Yeah, it's like you look over at the bench and you see, okay, if we have to, and I'm just sitting over there like, pick me, Chris. But I'm very happy to be here. And I did see a photo from Pete this morning on Instagram. He showed the LA lights when he was flying in, and he's just a bit of a jet setter, Pete, actually. And we've got a question that came through about some of Pete's investments in property and these types of things, which we'll get to today. But mate, what have you been doing this past week? What's happening in the world of Flint?
Look, it's an interesting time in the markets. It usually goes a little bit quieter here because school holidays come around and people don't want to list their properties, and everyone wants to have a bit of a break, and it's hard to go do open homes, etc. But it is a time where I think the market gets a little bit of energy back. There's a bit of buyer fatigue that happens when you're looking to purchase. Going to open homes is exhausting. Missing out at auctions is emotionally exhausting. And then usually people come to this sort of school holidays. They get that weekend away, they reset, and then they get reinvigorated, and they come back, we find, after the school holidays with a bit of extra energy, because the time pressure from, mid sort of early, late October till when listings really start drying up in sort of mid to late November is really short. And it can really surprise people. So that's definitely something we're seeing. We generally also see a lot of not too many buyers enter as well. A lot of buyers just have to get through the school holidays. They're getting exhausted, and they wait till when they get back to work till they send their loan docs. So it's usually a little bit of quieter time for us. There's lots of news articles going on and quite conflicting ones as well.
I saw you put out something on LinkedIn. This is going back a few weeks ago. You now do your newsletters and these types of things at Flint, which are really interesting, and you do some really great charts. One of the ones was like listings. It kind of looks like we can explain the price movement in property over the years just from listings, like supply and demand. But it looked like that combined with, I think another chart that you shared like a week later was like loan applications and lending activity. It looked like there was starting to see signs of like an uptick in lending activity. I'm just curious, are you starting to see more applications, more pre-approvals, more investor activity, even if they're not buying?
Yeah, I think it was like maybe 2 or 3 months ago when, our regular listeners to this would remember, and there was a huge shift in, interest rate expectations. Higher for longer was something we were starting to get quite embedded, and consumer confidence is all-time lows, etc. And then all of a sudden it flipped, right? Some data out of the US, actually employment figures aren't that strong, or maybe the rate cuts aren't far away in the US. And then all of a sudden that, higher for longer to rate cuts are on the horizon. And that flew through to the media, and then around the world, interest rate cuts have happened. And, people are starting to believe it's inevitable that rate cuts are very close. No more rate increases are coming. And that was a huge correlation with buyer activity. There was a lot of upgraders or people, particularly on $1-2 million plus properties, that were waiting till they had that certainty and clarity, because you don't really want to leverage up into a world where there's really high rates. And so we saw that, a huge shift in buyer demand there. At the bit more the lower end, there was always really strong buyer demand over the last few years. It's just, a rental crisis that's been really forcing people to try to get some security, and a lot of people wanting to enter the market to build wealth long term.
Yeah, it's been really interesting. Like down here in Vic, the sun's come out, and it seems like the agents have come out, and we have like an explosion of activity. Like I'm receiving text messages every other day from like, hey, new listing, but off market. And then I'm seeing like more like letterbox drops. It's like they're ready for something. It's like it could happen. And speaking to investors, I know for sure that all of a sudden the commentary is no longer, hey, I can put this money in a term deposit. It's going to be great for the next 3 or 4 years, to, oh, my bank's dropping rates, like on my term deposit. I should probably do something with all this money that I got now. And, that seems to be from the other side of the fence, like from where the money comes from, so to speak. There seems to be that sort of activity picking up. What else? Is there anything else that you've read or things that people should be aware of this week? I've got some things for you, but I'm just curious if you've come up with anything.
Look, I read two conflicting articles in the last 24 hours. One was saying the rental crisis is over, rents are falling. Other article said it's the landlord's market. And I'm pretty sure I was using the same research. So it's just hilarious when you get the same research and people take it on two extremes. And, but I do think there's some good signs. I mean, with the rental crisis and rental prices slowing, that's also good for our inflation story. That's also good for rate cuts. But it's still very tough out there. Vacancy rates are ridiculously low. And that's one of the things that supported markets through this last couple of years. In spite of very high interest rates, people have still wanted to buy because they can't rent. Look, the negative gearing, CGT, the election's coming around thick and fast. That conversation's starting to heat up week on week. It really brings out all the people who are pro it, all the people who are against it. Like, it's a divisive topic that sells a lot of papers and clicks. And so that's absolutely been flowing through the news articles. And I think, there's obviously, the listing numbers and the activity in the market. I think that's that story around lots of listings is starting to fade. And, you're not seeing that pop up as much as we were 2 or 3 weeks ago. And I think that really showed that the media latched on to higher listings greater than last year, but it hasn't been able to keep up at this because a lot of people have front-runner their listings. So I think that's quite hilarious that, that story is already starting to feel a bit, hasn't dated that well, right? We called out a couple of months ago. So maybe we're doing something a bit different today rather than Pete is usually super prepared with an amazing research for these each week. I'm probably the laggard, but I think we should just attack some questions, right? Because I think these are always good conversations.
Yeah, sure. We actually, I did want to circle back to something that I think when someone wrote in, their Australian Property Podcast listener, they actually wrote in quite a while ago, maybe 6 months ago, Chris. We answered a question. They had an apartment and they weren't sure what to do with it. It was kind of lagging the market. And they were kind of like just in two minds about holding on to it. And they actually ended up selling it because they wrote in another question. And I think it's just a bit of a typographical error. Went through to the wrong podcast. And we heard it on the show, on the Australian Investors podcast yesterday. And they said, and it was credit to you, mate. They said, like, I've this massive weight off my shoulders. I've no longer got that investment apartment. And now I'm going to recycle that money. They're looking to use debt recycling on their primary residence and go down a different path. And they said it was just a huge weight off their shoulders. So this is all to say, one, kudos to you, mate. But two, is that we love getting questions right across all of the podcasts, but in particular here on the Australian Property Podcast. I know Pete loves hearing from you. Amy does too. So everyone loves hearing from you. So please keep sending your questions in. The first question was something that I know very little about. And this comes from Raj, Chris. And they ask, what is your view on investing in NDIS property? I've no exposure to this. I don't know if any of your investor clients do.
Ooh, so it's a good question, Raj. Let's answer that. Let's just go back to that apartment question for a bit as well. And thanks for obviously writing that in. Look, I think when you've got an asset that is a dad or a dog and it's just not performing and it's fundamentally flawed for some reason, whether it's lots of supply or the demand's very limited because it serves a certain subset, just be really careful because those fundamentals are unlikely to change and they can get worse. And so what you're really hoping for is this dream time to sell. And what you've got to think through is how long are you going to have to wait? What's the opportunity cost? And even if I sell it in this dream market, there's going to be a reason why it's a dream market, whether it's massive cuts in interest rates, whether it's massive increase in borrowing capacity, whether it's just huge high consumer confidence, right? Well, most likely every property is going to do really well in that environment. And so, yes, you may make more money on your property and you've got this loss aversion and this sunk cost bias. And yes, it feels better that you sold it more than you would have 12, 18 months ago. But what happens if you transacted into a better property and you would potentially maybe have got more growth and even though you paid selling costs and buy costs, or maybe you got into equities, etc. So just be really careful on your behavioral biases when you've made decisions, because naturally you always want to win and we want to be proved right. But sometimes you can be proven right in a couple of years or you can be proven right in 20 years. But what is that difference in 17 years in the markets of what you could have done? Raj's question is an interesting one. Look, I do think there's a little bit of an explosion in these. Anything that where there's a ulterior motive to invest in. We saw this with NRAS a few years ago. Absolutely, you can see it with all the government grants into off the plan and buying new property and first home owners grants, stamp duty savings, etc. And so there has been in this NDIS. Look, we have had lots of people knock on our doors, if I'm honest, around this development space, and the returns and the way that it looks sounds so good, right? But I would just be really careful when you start to unwind these schemes. What are you actually buying, and how scarce is the asset, rather than what is the government incentive, right? Because what they do is they bring in a cash flow model and they'll give you this amazing, 2, 3, 20-page document that is all forecasting returns at 7% growth rates, because that's what the average did over the last 20 years in the suburb. Well, that doesn't mean that the property you're buying in, which yes, maybe have some incentives that offset and allow you to make it affordable, but does that mean you've got a great asset? And what happens if you want to sell it? Do you have to sell it to someone is in NDIS? Does that limit your buyer pool? What happens if that buyer pool evaporates? What happens if they end up buying the new properties where they get the new benefits for? So really think through any of these government incentives. It's never really a free lunch, if I'm honest. There's usually a negative that's not getting factored in into their presentation. And just remember, the property market is unregulated. Anyone can say whatever the hell they like, and you can never go back and say, hey, you told me that it would grow at this rate. Hey, you didn't tell me about that, that there was going to be a new housing lot over the fence, 1,000 homes getting reached. You didn't tell me there was a development application. You didn't tell me that I couldn't sell this to someone else. So it's all buyer beware. It's completely up to you, and there's no one else you can. And particularly, I've seen people target this in super funds as well. And yeah, be careful, betting your retirement on things like this. So yeah, any of these schemes, just take it with a big grain of salt. It would be my tip.
Yeah, that's really interesting. Like I often find myself getting kind of not lured in, but I guess sold into the ideas of things like DHA as well, defense housing, just because the certainty of things is something that I kind of cling to. Like I love the consistency, and I love if there is an opportunity to at least explore it. And this is not a knock on anyone or any opportunity with DHA as well, but it's just being aware, I think. And I don't think I'll ever get tired of you saying that it's about quality assets again and again and again, and that's something that I just keep coming back to. That's a good question by Raj, though, because I actually, like I said, I knew that it was a thing, and I see it in commercial property investing, and I see it with fund managers and that type of thing, but never in for individual investors. So Help a Mama Bear Out is who sent in the next question. They said that I'm now renting out my home as we have moved towns. It is 3 years since I purchased it, and it has gone up by a good $300,000. Do I work out the rental yield based on the original purchase price or the current price that I could sell it at now? I'm trying to compare if the investment, if I sold it, is worth moving to shares or not. So is the rental yield a direct match to the estimated yield from shares? And I think what we can do here, Chris, I think this question is more about not just about on the face of it, what's the rental yield and how do I calculate it, but also maybe there are other opportunities in here. Maybe there are a different way that someone could go about this.
Look, I do think it's a really smart question, to be honest. And I think it's often forgotten about is what the yield is today and what the future yield is. So sometimes people say, oh, I'm not going to buy that property, right? Because it's a 3% yield. However, if you buy a property that has got not many investors buying in that area, more and more investors are selling in that area. So rental supply, the amount of rent properties you can rent in that suburb or location is reducing. As prices of properties get more expensive, more people can't afford to buy, more people are forced to rent, and more people are forced to rent even though they're on higher incomes because the prices are running on them. And naturally, you're probably expecting, particularly if there's a bit of population growth and as a city it grows, that rental prices should go up. And so it seems really tough, right? I'm getting a 3% yield, but what if rents go up 40%? Well, that's now turned into a 4.2% yield. What happens if it continues goes up? So future rental price growth, I think, is delivered by not buying in areas where investors buy, and two, where investors are exiting, and also where there's really strong capital growth. Capital growth, I believe, leads to good rental price growth. And so, yeah, I think it's a great question, because what you're thinking is, well, no, the yield does change over time. Now, whether you keep it in that property, you have to then look at the yield, though, I believe, because you should always be looking at property and going, look, do I really want to, because as properties go up in value, you've got more and more money tied up, right? And your property is basically a leveraged investment. And the more leverage you've got, particularly into bigger and better assets, and, spread across number of properties, could get you a better return rather than having a lot of equity just sunk in one property. And so sometimes you do make a decision. There's never this buy and hold and never sell mentality. I think those people really don't do the hard work, and sometimes go, actually, you know what? Now property's had a good run. I'm better off to recycle that debt, pay off my home loan, buy a fully tax deductible, different investment. Yes, it's good, but it's not really a AAA grade asset. And so, technically you can do it on your initial investment, right? And go, okay, well, I invested 500, my rent's gone up a lot, so my yield's gone up a lot, and that's been a good investment. But then also, I think you've also got to look at it and go, well, now I've got 300 grand in here. How could I restructure things if I sold to potentially enter and get a better cash flow position and potentially get a better asset for capital growth? And so it's a great question to be thinking about. What's the alternative? And staying flexible. Sometimes a lot of property people, which is like that unit holder we spoke about before, they just get stuck and they never transact because it's the fear of not just also getting it wrong. Oh, I really should have held on for 2 or 3 more years. Like, you sometimes just got to make the decision, move on, no regrets. If it doesn't work out in your way, that's fine. I've made money on something else. Maybe it wasn't as much. So that's okay. I've made a decision. And I think when you free yourself of that fear of being wrong, you start making much more rational decisions in investment markets.
It's interesting because this person with this home may lose the principal place of residence, the capital gains tax exemption. Another thing that I thought about with this, Chris, is potentially even them refinancing up to whatever they can get and then using the proceeds to buy shares so they maintain the asset while also then getting a tax deductible loan that they can invest in shares. So from a broader financial planning perspective, almost as if they're maximizing their leverage, they're still getting their rental income on a property that they think is, pretty good property, assuming that it's a pretty good property, while also then being able to invest in shares, which will pay them tax-effective income. So that's another alternative as well, is even not transacting, as you said, but even just refinancing and making sure that you're making the most of the leverage that's available with that property. Does that seem like something that's reasonable, just generally speaking?
Yeah, absolutely. I might have missed the question there. Apologies that it was a home. So I was thinking more as an investment property. But if it's a home, yeah, absolutely. You've just got to, selling out and buying shares and then renting, you're right. Maybe you haven't got an asset growing for yourself tax-free. And you've got to think through, am I going to go into another home? But you're right, absolutely. If it is a home and they're happy there and it's growing tax-free, that doesn't mean you should never sell your home, in fairness. I've absolutely seen some great moves where people are going, I could really get out right now because I bought it really well. I've renovated really well. That property would sell really hot right in this market, and I can go buy another home and do it all over again and do another reno. I can think of a client just doing that a few weeks ago. So yeah, I mean, absolutely. If you want to stay in the property and you've got some equity and you've got the income to be able to refinance up to 80% usually on the property value, maybe you can have your cake and eat it. You've got a great asset growing tax-free. You're happy there. You've got all the lifestyle benefits of that. But now you can start to use that equity to start to build up some alternative asset bases. Whether that goes into shares or property really depends on your leverage and what you can do in terms of your servicing. But not just having, doing either or. I'm in property, I'm in shares. No. Let's build a portfolio and balance it over time where you actually do both.
Yeah, good strategy. I'm going to jump down to a question from Drew Pens, who asked a question about what banks offer debt recycling products. I've been told that most banks only do fixed/variable splits, and if the purpose of the split is to invest in shares, it will separate the loan with a higher rate. Is that right? So this is a very, very popular question that we're getting at the moment, Chris. I recently went through this process with Flint where I wanted to release equity from my home so I could invest it, do whatever I want with it, really. Is that particular to only a few banks, or do you and the team, when you do these refinances and these equity releases and go down this path with people, Do you find that only a few banks offer that?
No, pretty much every bank will do it, to be honest. You do have to be careful how you lodge the loan, in fairness. I think you need to be, when you lodge a loan, you kind of think about yourself from a credit assessor's point of view, right? What you want to do is make the credit assessor feel that this is being thought through. The client absolutely understands what's going on. They absolutely can afford it. They have reduce any risk in the bank's eyes. So when we lodge a loan, we spend a lot of time up front. A lot of brokers early days miss this step, and in fairness, I did as well. And you try to just lodge it, and it's a little bit of a mud on the wall approach because near enough will be good enough. She'll be right, mate. I'll lodge it with a credit assessor. No. What a credit assessor does, if it's not presented well, they look at it and go, oh, I'm not sure if I want to do this. And their mind is already like, I'm going to make this difficult, right? Because I need a lot of information. So I'm going to ask for a lot of information. And then I know the broker's probably not going to give it all to me. And then it saves me the work. And so when you lodge a loan, whether it's for debt recycling or upgrading or investing or anything like that, a good broker will do some detail notes. Jack and Jill, are looking to release some equity to invest. They've got, really strong incomes. It services no problems with their credit file, etc. So, debt recycling is really quite easy to organize at pretty much every bank. You're right, though, you're best to split your loans, and that's fine. So, people like simplicity. I've got a mortgage, a house worth $1 million. I've got a mortgage of 600. And if I release equity, I just want my mortgage to go up. Well, no, what you've got to be really careful is washing your debt together. So, and what I mean by that is that, when you've got a home, that's non-deductible debt. When you release equity, that could be deductible debt if you use it to buy investments. And what you need to do is have a real barrier. And that's what the split loan allows you to do. So when the accountant does your tax, okay, show me your interest on your mortgages. Well, no, this is my interest on my $600,000 loan. Okay, that's not deductible. This is my interest on my $200,000 loan. That is deductible. I'll put that in your tax return. Whereas if it's combined, the accountants go, oh, how much is deductible? How's not? And so be really careful and always kind of split your debt. I know it sometimes, and even when you have to split it across a number of properties and avoid something called cross-collateralization, it can get messy. But if you just, banks are good now. You can label all your debt in different buckets and put names on accounts. And, that's actually a bit of a game changer, I feel. Because then you can look at all your splits and go, well, that split was for my shares. That split's for, property X. And even though there's lots of splits, you know which ones are because you've labeled them.
Yeah, we had Ben, obviously, on the show recently. I think Ben's title's Head of Advice at Flint. And for people that haven't listened to that episode, that was a wonderful episode about structuring, about using loans secured against property in different ways. And I went through this process, did equity release, and I'm going through again with you guys, and we're doing that through NAB. And that's been really interesting because you just see these accounts appear and there's different components, which makes it easier and easier and easier for the accountants to then work with and understand what's actually happening. So and the amount of information that Ben and the team have produced, or requests and then get me to work with, it's actually really, really helpful. So New to Investing asks a question. They say, I'm FIFO in WA and got ahead in my mortgage and really didn't want to invest in property, but since had a change of heart through conversations, etc., as I would like to set myself up financially. What are your thoughts on buying older houses with huge blocks and converting them into triplexes or units? I was thinking that I could possibly sell one to help cover costs and keep the other two as investments. So this is a pretty common thing that people think, Chris, is big block, good salary, I could leverage, maybe release one of the subdivisions or the blocks early. Thoughts?
Yeah, so there's two ways to make money on property, right? It's probably more than two, but anyway, let's just go with that. You can buy assets that just go up in value. Generally, what you're doing is you're buying a block of land that's becoming more and more desirable over time and more scarce, and over time, more and more compete on it and push the price up, right? The other option is something called manufacturing growth and manufacturing equity. And that's where you're doing something to the property. That could be renovating, but it could be doing construction. It could be doing, subdividing, doing duplexes, treeplexes, whatever that's called. Townhouse developments, right? You can definitely do this. I find that what happens is, though, when people do this, they do it in areas where other people are doing it. And that just, you look at fundamentals on property, one thing that drives prices the most is scarcity. So if you go and do this, buy a big block of land, and there's lots of big blocks of land around, is it scarce? No, right? And so is someone going to compete on that block of land and pay an enormous amount, like from a developer's point of view? Well, no, because if in the future you try to sell your block of land, you buy it for 500, you want to sell it for $1 million, well, they'll just go to your neighbor and say, hang on a sec, I'll give you 650, I'll give you 7. So it's when you buy land that's really scarce. Now, you could also buy land that's really hard to subdivide. And, you could know something like with town planning that, what other people don't know. I've seen some people do amazing there that just have that real eye to, you'd see an opportunity that others don't. But assuming you don't have that, and assuming you're not buying land that's scarce, I probably wouldn't go and buy that big block of land. I'd go and buy a better block of land that is more scarce, and do a smaller renovation to it, rather than trying to buy something and do this big reno to it, right? This big townhouses. The other thing is your risk definitely goes up when you're doing these multi, townhouse developments. You thought you could get 6, but then you could only get 5 through council. There goes your profit. I can think of a number of clients just recently that's happened too, where they've, the whole feasibility changes when your number changes, or the build cost blowout, etc. So I think, if you're starting into the property investment journey, I do think it's a bit more an advanced strategy, and the risk goes up. And yes, the reward potentially is there if you get it right, because you A, get the growth in the land, but B, you can manufacture growth and you get the best of both worlds. And then potentially you get the market forces. The other thing is with these townhouse developments, you want to do it where other people aren't doing it, and you want to sell it in markets when it's undersupplied. And so I've seen people do this. They've gone down the right strategy. They've gone and bought a scarce block of land, a good block of land. They've gone and done their townhouse developments. And when they go to sell it, the market, tanks. It's just the market shifts. There was a real lot of momentum in the market. Then 2020 happened, and or 2019 happened, or just a downturn that you weren't expecting, and then bang, you get stuck holding these properties, and you got to really ride the wave out. And so, absolutely, you can make money in this. We've seen clients make some huge amount of money in manufacturer equity, but I do think it's a more advanced strategy, and I do think you've just got to be really careful what you do, because you definitely want a scarce asset on the end of it.
Yeah, I think that's a good point that you make. It's kind of like the plan B. Okay, yeah, sure, you might want to manufacture equity, but make sure the asset is good, because plan B would kick in and you ride it out, as you said. And the fact that they come in with the name new to investing and then they go straight for the advanced strategy is quite interesting. So maybe it's a case of one level at a time, just keep leveling up over time, getting the experience, working with a good team, getting some notches on your belt, so to speak. A question came in from Ben, who said, hey guys, I'm now in the position where I'm wanting to get an investment property to start my portfolio. I am wanting to do this to create equity to help buy our forever home, as well as creating a future for our family. I'm looking at a 5 to 10 year strategy for creating compound growth. I would like to get a mortgage if we were to do this as a buy to let. I also have the opportunity to co-invest with my partner's mum, who wants to do something with her cash. This would mean the ability not to have to get a mortgage. My concern is that I would be losing out on the compound growth in the years to come, as she would obviously need a return too. I guess my question is, which route do you think would work best for equity and future growth? So just to summarize here, Chris, they've got 2 options. One, just a standard, I'm going to invest in an investment property, get a mortgage. The second one is, I could work with my partner's mum, we could invest together, but she would want an exit. How do you think about that? You must come across that with like a lot of families and a lot of people trying to do this together.
Yeah, so the first thing I'd go to is, the plan here is to make some money to then buy a home. Okay, well, where do you want to live long term? Like, where are you ultimately wanting to end up? Is that a good investment? Is it not? If it's not, as in it's not a scarce block of land, it's in the middle of nowhere, there's not really demand pushing prices up, then you go, you're right, we got to move to this real country town that, ticks those boxes, right? Then I'll go, well, yeah, let's not go and put our money there today. We're not moving there 5, 10 years time. Let's make some money, and then we'll buy that non-scarce asset down the line. And hopefully we can still have good investments growing for us. We don't go all in on this poor block, right? If it's a good location you end up wanting to end up in, you've got to be really careful trying to outrun that market, because there's risk involved with any type of investing, right? The market you buy in hasn't performed as well. Like someone who's bought in Melbourne versus over the last few years versus someone who bought in Perth or Adelaide, right? You know, you might say, well, that's worked out really well for that person wanting to buy Melbourne. They've got an invested in Perth and Adelaide. They make their money and they can go buy back into the Melbourne market. But if it was vice versa, someone living in Perth and said, I don't want to buy the Perth market. I'm going to go and buy in Melbourne as an investment property, and then Perth ran on them. God, they'd be in a bit of pain right now, right? They could have just bought something in the Perth market. So you just got to be careful trying to outrun investment markets. They can go against what you think. And this situation, they don't make as much money on the investment. The market, they could have potentially just waited a couple of years, maybe, you know, bought with their family in the area they want to live long term. There's usually a joint benefit there, actually. So de-risk, and family usually want to be around family, not always. And so I would just consider that first. Can you get your investment in the area that you want to live long term? It de-risks a lot of your investment journey and exposes you to the market you ultimately want to be in. Maybe it's not your dream home. Maybe it's just a starter house that you can renovate over time that one day you will sell. And maybe you can consider using something called the 6-year rule, where you live in it for 6 months, move out, and let that property growing for you tax-free. The second part to this question, you know, do you, go down the investment route? Yes, you can do it yourself. And I do prefer to do it yourself than buying with family. Different goals, different needs, life plans change. Now you've got your life plans to consider, plus you've got your mother's. What happens if they've got a partner, or they get a new partner, or some health issues, or they want to retire, or people think their life's is set in stone. Things change, right? And so what the issue is that your timeframes could be completely different. Secondly, if you said you don't need a mortgage buying with them, well, why don't you potentially still buy with them and get a mortgage, right? And then you basically say, well, your 50% was paid by cash. Okay, your return is 50% of the profits and 50% of the rent, right? I'm going to take the other 50%. I'm going to use debt, right? So I still get 50% of the returns, but I've got to service the mortgage, and I get 50% of the rent, and I negative cash flow it. So I don't know why you don't need a mortgage buying with it. If absolutely you're not getting a mortgage, so you've got to say, well, what am I putting in? If we don't, maybe I'm putting in cash. And putting cash into buy investment properties reduces your return on equity dramatically, right? Because resi property doesn't grow that fast, really, when you're just putting dollar for dollar. I'd probably prefer shares than putting money into property if I'm just putting in cash. It's too lumpy and the returns aren't that great. So that'd be my answer, Bet, is that it's not, you might pigeonhole your thinking here, and just be really careful doing it, whether it's parents or brothers and sisters or friends. Be really careful joining up. It's like a business partnership.
Absolutely.
Change.
I've probably seen it go wrong more than it's gone right when people don't have they don't approach it like a business relationship.
Yep.
Particularly later, if someone's later in life, they have different financial needs and whatever. The final question is a bit of fun, I thought, because Pete's not on the show. It comes from Sean, and he says, Pete has mentioned that he has an investment farm in farmland in Britain in the past. I would like to know more about the reasons to hold this asset class anywhere in the world and what the downsides and returns are like. So just a quick one on this. Pete is obviously from the UK, so that's where him and his partner do spend a fair bit of time every year. But you should also know that Pete is the type of guy that buys property and doesn't often sell it. And so that includes maybe some farmland and these types of things. But Pete's told me once before, Chris, that, and I did some prep in order for this episode, there's no inheritance tax in the UK for certain types of farmland. So this is why James Dyson of the Dyson fortune and many other celebrities have those farms in the UK where you can potentially pass things on to the next generation and get things moving along without being subject to the 40% inheritance tax potentially. Now, I'm not saying this is Pete's intention, but I just wanted to call that out. It's a very interesting quirk of the UK system versus Australia. We don't have inheritance tax per se, but if you don't structure your estate correctly, you can actually pay tax. So it is a little bit different in the UK than it is here in Australia, but I thought that was just worth mentioning, and I'm sure Pete can add some more context around that in time. Anything else to add, Chris, on that one there?
Look, I do remember when an article, and I've just quickly typed it into Google because I haven't prepared for these questions. I like to just hit them on the fly. But an article a few years ago, just the performance of agriculture land. And Wilson Asset Management did it. You can just type it into Google, and it's outperformed Sharon's property. It's performs really well over the last 20 years. And so I think you just got to be careful. I do think mining, it does goes in booms and bust a little bit. And I think, I think it can be a great investment. Obviously, whether you can make money on the land as well through, having cattle on it, you do it yourself, or you could just rent the land out to other farmers, right? So I think there's definitely, but I do think you've got to be, particularly if you can buy farmland that turns into residential, that's when the numbers go through the roof, right? You just got to, not at the moment too much, to be honest. We haven't seen too many of the Stocklands and, big greenfield developers out there. We had a lot of money, Chinese money, doing this just up till recently. I think a lot of that money's gone out of the country, if I'm honest. But they were buying up, big blocks of land, 30, 40 Ks north of Melbourne for 40 mil, right? And so one day it was a farm, the next it's 10,000 homes, right? And that's where farmland just goes through the roof. The returns on that are unbelievable for the farmers. And so if you can get the best of both worlds, where you're buying a long-term asset that you can make a bit of income on, and then obviously at one point you could potentially sell it to a developer, that's where the numbers go through the roof. But obviously every year, our land that's available for agriculture is getting smaller and smaller, right? Whether we're building into it or whether it's getting damaged with climate change and things like that. And that's obviously becoming more scarce. And so, and a lot of the big money around the world is made in agri. Whether it's you look at the Gina Reinhardts of the world and Andrew Forrest, Forrest, exactly. There's a lot of money that they put into this agri space,
There's an interesting quirk. One final thing I'll finish on with the UK in particular is that you pay 40% tax on inheritance of anything above £325,000 in the UK. But if you leave things to your spouse and that sort of stuff, you don't pay inheritance tax on that component. Interestingly, you can actually leave that money to your local sports club and there's no tax on it. I feel like if I was an Australian sports association, I would be petitioning the Aussie government to say, hey, let's introduce an inheritance tax and copy the UK, because we're going to get a windfall from all of our life members that want to leave some money to us. And I think that would work wonders for local sporting clubs and groups like that. But Chris, this has been heaps of fun. It's good to be back on the show. I don't get a chance to chat like this, so it's great to catch up. And folks can head to the link in the show notes. If you're looking to refi, if you're looking to buy your first home, invest, get Flint on your side. Like I said, I've been going through the process. I've actually got to send Ben an email today. So get in contact with Flint. You'll find a link in the show notes. And please send us your questions. There's also a link there to ask a question. Select the Australian Property Podcast. Chris Bates from Flint, mate, absolute pleasure.
Absolutely. Always good to chat. And I can't believe you said that maybe we should introduce an inheritance tax in Australia. That's basically what you've implied here. So just be careful. I think Owen might be running for Parliament in the next few years.
Yeah, probably the Labor Party, to be honest, mate. No, mate, it's great to chat. Thanks for watching this video on the Rask Network. While you're here, don't forget to like and subscribe so you can get videos each and every day on business, finance, investing, and so much more.